Temasek Holdings has posted its biggest increase in net portfolio value in more than a decade, beating expectations. It jumped 25% to a record high of 381 billion Sing dollars in the financial year ended March. Now, this comes after a roughly 2% drop that was seen last year. Group net profit also smashing through the highs of the last 20 years to come in at $57 billion. The annual report goes on with other record figures. Divestments in green came in at $39 billion and investments in blue at $49 billion. Most went into assets which Temasek felt were fairly priced during the pandemic. Now, one-year shareholder returns, they also came in at over 24%. That's up from a minus 2.28% last year. It's the best showing in the past 10 years.
Last year, because we have a March cycle, markets were down at the time. They're in a better place now, so the public portfolio has done well. But so have a number of our private companies. Going back to the prior question, a number of those have benefited from public listings in some cases, and others through marks in their private markets.
Temasek remains most invested in Singapore and in China, with the two making up more than half of its portfolio. But the Americas, they accounted for the largest share of new investments and now takes a 20% share compared to 18% the previous year. Financial services, that's still the largest sector, followed by telecommunications, media and technology. But it has moved from traditional sectors like banks and put more focus on those fintechs, e-payments and digital content. It's all part of Temasek's 4 refreshed trends for future investments that it says were sped up because of the pandemic. For instance, digitization and the future of consumption. Big names that it's backed include C Group, which is behind e-commerce platform Shopee, as well as BioNTech, co-developer of the well-known COVID-19 vaccine.
When you look at what happened during COVID last year, all of us working from home, what does it mean? It means that digitization has been a very, very prevalent area. That gave a very good idea to companies that if they are not disrupted yet, some of them will have to disrupt themselves to survive. And this trend we think is irreversible, and it will get accelerated.
Temasek says it will also double down on investments in sustainability as it cuts across sectors. For a start, it set an internal carbon price of $42 per tonne of carbon dioxide equivalent. It says that's to better internalise the costs of emissions as economies deliver on the Paris Agreement goals. Temasek says this metric will be used to guide its investment decisions. And that means more funds into opportunities for decarbonisation or trading carbon credits. It's already invested into carbon capture technology and formed a council to share knowledge and tools for climate risk assessments. Temasek says it is urging businesses in its portfolio to reduce emissions, but it won't set targets for companies.
We will not preclude ourselves from investing into companies that are emitters. But the important question is this company aware? Do they have a plan for the climate transition? Do they have a good climate strategy that will allow them to contribute positively to the climate transition? So the approach that we are taking is not to take an exclusionary approach, but really to see if we can engage with companies and businesses to drive the investment into new capabilities that will support a much more climate-aligned economy.